This is part 1 of the presentation for Module 8 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In Module 8, we will cover topics related to the analysis of stockholders' equity, including issuance and repurchase of common stock, payment of dividends, stock splits, convertible securities, stock-based compensation, earnings per share, book value per share, and accumulated other comprehensive income. In this learning objective, we will examine stock as a financing source and explain its various features. Companies raise funds by selling shares of stock to investors in addition to borrowing, but unlike debt holders and other lenders to the company, shareholders elect a board of directors that hires executives to oversee company operations. While interest and principal paid to lenders is fixed by contract, shareholders have no contractual return. There is, however, the potential by shareholders to receive dividends and derive large value from future price appreciation of company stock. The stockholders' equity section of the balance sheet reports the book value of the stockholders' investment as determined under accounting rules. This measurement of book value differs from the market value of stockholders' investment, which is computed as share price multiplied by the number of shares outstanding. Market value is determined by supply and demand for the company's outstanding shares in the marketplace as shares are actively traded among investors. This slide illustrates the stockholders' equity section of Johnson & Johnson's balance sheet. We will use Johnson & Johnson's stockholders' equity to illustrate equity concepts. There are two types of stockholders' equity accounts: contributed capital and earned capital. Contributed capital is the net funding a company receives from issuing and reacquiring its shares. This is the funds received from issuing shares less any funds paid to repurchase such shares. Johnson & Johnson is authorized to issue up to 2 million preferred shares, but to date has not issued any, so the balance is zero. The balance sheet reveals a number of details about Johnson & Johnson's common stock. First, the par value of the common stock is $1 per share. Johnson & Johnson can issue up to 4,320,000,000 shares without further approval from shareholders. To date, it has issued over 3 billion shares at $1 par value for a common stock balance of 3,120 million. It does not report any additional paid-in capital, so we can infer that no shares were sold for more than $1 par value. Earned capital includes two accounts: retained earnings and accumulated other comprehensive income. The accumulated other comprehensive income account reflects the cumulative total of changes to stockholders' equity other than from transactions with owners and transactions reflected in net income. This account can be a positive or a negative amount. Accumulated other comprehensive income is the cumulative net unrealized or holding gains or losses related to key balance sheet accounts, primarily pension, investment securities, derivatives, and foreign currencies. These holding gains and losses will flow to the income statement and be included in retained earnings when they are realized. Retained earnings is the cumulative net income received since the company's inception, less all dividends the company has ever paid out to shareholders. Johnson & Johnson reported $106,216 million in retained earnings at the end of 2018. The Treasury stock account is for the repurchase of a company's shares in the open market. Johnson & Johnson held 457,519,000 shares of Treasury stock at the 2018 year end, for which it paid $34,362 million. Like all balance sheet accounts, the Treasury stock balance is a cumulative amount that reflects open market purchases and subsequent resale of its shares. A measure commonly used by analysts and the financial press is book value per share. This is the equity of the company that is available to common shareholders. Johnson & Johnson has no preferred stock outstanding as of 2018, and therefore the book value per share is the stockholders' equity divided by the number of common shares outstanding, which is shares issued less Treasury stock. The book value per share was $22.44. Comparing this to market price per share of $129.05 yields a market to book value ratio of 5.75. The median market to book ratio for the S&P 500 companies at the end of 2018 was 2.91. So the market value for Johnson & Johnson was higher relative to book value than the median S&P 500 companies. This statement of stockholders' equity reconciles the beginning and ending balances of the contributed and earned stockholders' equity accounts. It highlights how net income and dividends impact retained earnings. It also identifies how cash raised from new shares issued and cash used to repurchase shares in the open market. Changes in key balance sheet accounts not recorded in net income or not arising from transactions with shareholders are included in other comprehensive income, and the cumulative sum of that account is reflected in accumulated other comprehensive income. Johnson & Johnson's net income added to retained earnings was $15,297 million. Cash dividends paid were $9,494 million. Johnson & Johnson's policy is to use Treasury shares for employee stock-based compensation plans. It purchased additional stock on the open market during the year at a cost of $5,868 million. It reported as other comprehensive loss of $1,791 million. In 2018, certain accounting rules changed for revenue recognition and income taxes. In adopting these new rules, companies had to make retrospective adjustments to equity accounts. Johnson & Johnson reported a total cumulative adjustment of a negative $486 million, split between retained earnings at a negative $294 million and accumulated other comprehensive income, a negative $232 million. Preferred stock is a multi-use security with a number of desirable features. In addition to usual dividend and liquidation preferences, preferred stock has two other common features. One is yield. Preferred stock can be structured to provide investors with a dividend yield that is similar to an interest rate on a bond. Dividends, unlike interest expense, are not deductible by the corporation for tax purposes. Therefore, the after-tax cost to the company for preferred dividends is higher than the after-tax effective rate on a bond. The other is conversion privileges. Preferred stock can contain an option that allows investors to convert their preferred shares into common shares at a predetermined number of common shares per preferred share. Both features of preferred stock are illustrated on the slide for Corning, Inc. They have fixed-rate cumulative convertible preferred stock. This stock pays a fixed dividend of 4.25% on the per-share issue price of $1 million, which is higher than the effective rate on Corning's debt securities. The annual dividend on the preferred shares would be $97.75 million, calculated at 4.25% times the $2,300 million par value. Samsung Display owns the preferred stock and has the option to convert the preferred shares to common at the rate of one preferred share to 50,000 shares of common. If all the preferred stock were converted, it would result in an additional 1,150 million additional shares. The current stock price of Corning is $30.21, favorable for conversion. The sticking point is that the current dividend on the preferred shares is $42,500 per share, whereas the dividend on 50,000 shares of common stock in 2018 was only $9,000 at 18 cents per share. Thus, under the conversion, the preferred shareholder would receive a much lower yield. Johnson & Johnson has one class of common stock that has the following attributes. The par value is $1 per share. Par value is an arbitrary amount set when the company was formed and has no relation to or impact on the stock's market value. Generally, par value is irrelevant from an analysis perspective. It is only used to allocate proceeds from stock issues between the two contributed capital accounts on the balance sheet, common stock and additional paid-in capital. Johnson & Johnson shareholders has authorized 4,320,000,000 shares, but the company has only issued 3 2,119,843,000 today. Year-over-year changes in the number of issued shares represents the number of shares of stock issued in the current year. To date, Johnson & Johnson has repurchased 457,519,000 shares from its stockholders at a cumulative cost of $34,362 million. Treasury shares do not have voting rights or the right to receive dividends. The number of outstanding shares, 2,662,324,000, is equal to the issued shares less Treasury shares. The number of outstanding shares multiplied by the market price per share yields the market capitalization or market cap for the company. As of December 31st, 2018, Johnson & Johnson's market capitalization was $343.6 billion, calculated by multiplying the outstanding shares by the market price per share of $129.05. Many companies report an additional equity account called non-controlling interest. This account arises when the company controls a subsidiary but does not own all the subsidiary stock. The non-controlling interest is the portion of the subsidiary stock not owned by the company. The non-controlling interest account increases with any additional investment made by the non-controlling shareholders and by their share of the subsidiary's net income whose stock they own. The account decreases by any dividends paid to the non-controlling shareholders and by their share of any net losses of the subsidiary. To illustrate non-controlling interest, we will use General Mills' May 26, 2019 shareholders' equity, which includes $313.2 million of non-controlling interest, compared with $7,367.7 million of total equity, a larger percentage at 4.4% of total equity than the average of 0.056% for S&P 500 companies. The question arises as to which measure of equity we use when computing ratios, the total equity or the equity attributable to the company's shareholders. The answer depends on the analysis. For return on equity and market-to-book ratios, we use equity attributable to the company's shareholders, and for leverage ratios, we use total equity. Return on equity focuses on the return of the company's stockholder relative to their investment. Leverage uses total assets because liabilities finance all assets and not just the stock shareholders' portion. Market to book uses just the equity of the company's shareholders because it measures the parent company's stock price to the book value attributable to the company's shareholders. However, in practice, total equity is frequently used if the non-controlling interest is immaterial and does not affect the ratio. In this learning objective, we will analyze stock issuances and repurchases. Companies issue stock to obtain cash and other assets for use in their business. Stock issuances increase assets by the issue proceeds, the number of shares sold multiplied by the price of the stock on the issue date. Equity increases by the same amount, which is reflected in contributed capital accounts. If the stock has a par value, the common stock account increases by the number of shares sold multiplied by the par value. The additional paid-in capital account increases by the remainder. Stock can also be issued no par or as no par with a stated value. For no par stock, the common stock account is increased by the entire proceeds of the sale, and no amount is assigned to additional paid-in capital. For no par stock with a stated value, the stated value is treated just like par value. That is, common stock is increased by the number of shares multiplied by the stated value, and the remainder is assigned to the additional paid-in capital account. To illustrate the financial effects of stock issues, we will assume that Johnson & Johnson issues 1,000 shares of common stock with a $1 par value for $100 per share. Cash increases by 100,000 equal to 1,000 shares times $100 per share. Common stock increases by the par value of shares sold, or 1,000, and additional paid-in capital increases by the $99,000 difference between the issue proceeds and par value. Once shares are issued, they trade in the open market among investors. The proceeds of those sales and their associated gains and losses, as well as fluctuations in the company's stock price subsequent to issuance, do not affect the issuing company and are not recorded in the accounting records. Johnson & Johnson has repurchased 457,519,000 shares of its common stock for a cumulative cost of $34,362 million as of December 31st, 2018. One reason that a company repurchases shares is because it believes that the market undervalues them. The logic is that the repurchase sends a favorable signal to the market about the company's financial condition, which positively impacts its share price and thus allows it to resell those shares for a gain. Any such gain on resales, however, is never reflected in the income statement. Instead, any excess of the resale price over the repurchase price is added to additional paid-in capital. GAAP prohibits companies from reporting gains and losses from stock transactions with their own stockholders. We will now illustrate the financial effects of stock repurchases. Assume Johnson & Johnson repurchases 200 shares of its stock previously issued for $100 for $90 cash per share. Cash and stockholders' equity would decrease by the purchase price of $18,000. Treasury stock is a contra-equity account in that it reduces equity. Now assume that Johnson & Johnson resells the same 200 shares of Treasury stock for $95 cash per share. Both cash and equity increase by the proceeds of $19,000. The Treasury stock account is reduced by the $18,000 cost of the Treasury shares, which increases equity, and additional paid-in capital is increased by $1,000, equal to the $5 difference between the resale price of $95 and the original cost of $90 times the 200 shares. Again, there is no effect on the income statement as companies are prohibited from reporting gains and losses from repurchases and reissuances of their own stock. The Treasury stock section of Johnson & Johnson's balance sheet is shown on the slide. Johnson & Johnson repurchased a cumulative total of 457,518,000 shares for $34,362 million, or an average of $75.10 per share. While these shares are legally owned by Johnson & Johnson, they have no voting rights and receive no dividends. Treasury shares can be resold when Johnson & Johnson needs to raise capital or acquire another entity. Treasury shares can also be used to compensate employees and executives. Sometimes companies retire Treasury stock. In that event, the Treasury stock account is reduced by the cost of the Treasury shares retired, thus increasing stockholders' equity, but also reducing capital stock and additional paid-in capital accounts by the same amount. When Treasury shares are retired, total stockholders' equity remains unchanged. In recent years, a large number of companies have not applied the Treasury stock method described, but instead applied the retirement method for stock repurchases. Both common stock and additional paid-in capital are reduced by the original issue price of the stock, and retained earnings are adjusted for the difference between the amount paid and the common stock and additional paid-in capital. Some states, such as California and Massachusetts, now require this method. Microsoft used the retirement method in its 2018 Statement of Stockholders' Equity. Common stock and additional paid-in capital were reduced by $3,033 million and retained earnings by $7,699 million for a total of $10,732 million. Interestingly, this helps to explain why Microsoft reports such a low balance for retained earnings. Stock buybacks have increased dramatically over the past several years, such that many balance sheets report large levels of Treasury stock. The effect of Treasury stock on key ratios, including return on equity, is material for many firms. When a Treasury stock balance is extreme, the equity balance can become very small, yielding inflated return on equity. In more extreme cases, total stock repurchases can cause a negative equity balance and a negative ROE, which is uninterpretable. We discussed two ways to deal with the effects of Treasury stock in Module 3, and we will add another one in this module. One way is to use metrics that are less sensitive to negative equity, such as ROA and RNOA. Another is to compute ROE without adding back Treasury stock, after adding back Treasury stock, which is illustrated on this slide by AbbVie for 2018. After adding Treasury stock to equity, the return on equity ratios for 2017 and 2018 were 32.7% and 34.8%, as compared to 109.1% and a negative 339.6% before making the adjustment. Another is to substitute market value of equity for book value, which is also illustrated on this slide for AbbVie. When market value was used instead of book value, ROE for 2017 and 2018 were 4.2% and 3.9%. When analysts use market value of equity to compute return on equity, they must apply the adjustment consistently across years and for all companies in the comparison group, even if the comparison companies report no Treasury stock. And this is the end of Part 1 of the presentation for Module 8 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs.